Hello, Narendra garu.
Hello.
Hi Andy, good evening.
Hi.
Yeah, hi Andy. You can start the session now.
Okay.
Yeah.
So, hi everybody. Today we're going to discuss about the fractional investment opportunity with our company Jelly Belly Food. Before I get into the details of hello.
Hello Andy.
Yeah.
Actually నేను మ్యూట్ చేశానండి నేను మీరు carry on.
Okay. Before I start the presentation about the opportunity, I'll just give a brief about the company. Jelly Belly Foods is the parent company that owns brands called 100, Gourmet Shawarma, Courtyard, CL, and Homely Bowls. So these are all the brands that the company holds. The company has been in the food industry for the last 6 years. I myself, I am a graduate from BITS Pilani, and I've done my MBA from ISB. And I worked for 10 years in infrastructure domain. And I was, prior to starting my venture, I was the project lead for the Amravati project, the new capital city project. I was the project lead for the capital city before, in the previous term of 2014 to 2019. So after 2019, I gave up that job because the government had changed and there were other priorities, and then started my own company in food and beverages. Since then, we started out very small. We started out very small with 1,500 orders a month, doing around 3 to 4 lakhs billing a month in 2019. Then we had to go through Corona, and we survived Corona. In 2021, we started expanding. And today, we are proud to say that we are doing 37,000 orders a month and growing day by day. We'll be doing close to 60,000 orders by end of this year. We've opened Hyderabad. We have 18 outlets in Hyderabad. Sorry?
So background disturbance Narendra garu.
Why are you not muted them?
Yeah, I request everyone mute yourself. It's getting
You
disturbed.
can mute everybody, no? If anybody wants, they will raise the hands.
Yeah, it's almost muted.
అలా చిన్న అది
So yeah, I'll just continue anyways. So today we are doing 37,000 orders a month. We'll be close to hitting 60,000 orders by end of this year. We have 18 outlets in Hyderabad. We started expansion in Bangalore. So we are a full-fledged food company. That's what I wanted to tell in a brief, that food is our main business. We are in this business with all the team and everybody. We have people who have worked with Subway, who have worked with Creamstone, who have worked with Rebel Foods, all the top companies, Swiggy. Those are all the people who are running in our company in different verticals. So now that I've given a brief about the company, so the company operates in a way that it's a house of brands. So we have 3 brands live. We are working on launching 2 more new brands. I mean, one is already existing. We want to expand that, and the other one is a new brand. So here is where we wanted to try out a new model, which is a fractional investing model, where the investor is putting in the money, and the brand and the company is operating the outlets and sharing the profits with the investor. So this is a dividend kind of a investment. It is not like a investment into the company where you hold shares. It is purely based on the project, and there are dividends for each of for the amount that you have invested. So second, I want to tell you about the unique aspect of this model. The unique aspect of this model is that, as I was telling you, we have 18 outlets as of now, spread across 10 locations. So our idea now is that we have two brands with us. One is called Homely Bowls. This is a bowl company kind of a concept where we have lunch and dinner bowls. We are targeting the young crowd, first-time jobbers who live out of their homes, who want to eat something good in the afternoon and at night, want to fill up their stomachs. So for them, we have launched this Homely Bowls. Bowl concept is something that is growing very fast. And since we are in the industry and we are experienced with this, we wanted to try our own aspect of it. The product has already been, we're already selling under a different brand name to Zomato. Zomato, there is this brand called Everyday on Zomato. So we are the whole and sole supplier of food for Zomato for that brand. So we already have the formula for it. We wanted to try our own brand. So that is where Homely Bowls comes. Second thing is CL Desert Bar. CL Deserts is already existing. It is a supplier of high-end cakes. We do cakes to the order of each cake costs around 18,500 to 20,000 per cake. So we do high premium cakes. We have a very good bakery staff. So we wanted to make more utilization of the staff and churn out a dessert brand. We also supply breads to Qmart in the city through the CL CL Desert Bar. So CL is already an existing one. We have Homely Bowls, which we are planning to launch. So each of them, we want to launch 10 outlets of those, 10 outlets of Homely Bowls and 10 outlets of CL. Now, the beauty of this investment is that all these 10 outlets of each and every brand, will be launched in our existing kitchens, which has already existing equipments and has the manpower. So what will happen in this model is that whenever we are opening new kitchen on this brand, on any particular of these brands, what will happen is that you, as a part of the project, will be operating the item, will be investing in the plan where only 1/4 of the cost is shared for the putting up the outlet. So suppose somebody else wants to start a Homely Bowls brand, Homely Bowls outlet. You will have to invest in the place, rental advances, manpower, full equipment. And that is that will cost you around 14 to 15 lakhs at the bare minimum to start an outlet. But that is where this model comes into the forefront, where we are launching these stores at 4 lakh of budget. That is because we are launching them on the existing kitchen, because of which your rental burden will be lesser. The number of equipments would be only the equipment for operating. The manpower will only be the additional manpower required for it. So that is the beauty of the model, where you as a investor or we as a brand, we have already the existing setup. We are just trying to make more utilization of it. And whatever is the incremental cost, only that is attracted towards the bottom line of this company, of this project. So because of that, your break-even points for each of the brands is very less. Now coming to the revenue part, we are expecting a revenue of total 90 lakhs per month from the project. That is what we are expecting is 30 lakhs of revenue from each of the 10 outlets of Seal on an average, and 60 lakhs of revenue from all the 10 outlets of Homely Bowls. So what we're expecting in a way is that the Homely Bowls will do 20,000 rupees per day in sales, and CL will do 10,000 rupees per sale, 10,000 rupees per outlet per day in sales. Now we want to give a brief comparison of how much an average bowl brand does, an average desert brand does. So on average, the bowl brands that are there, which are rated 4.1 and above, they do around 35 to 40,000 a day. That is the average. So what we're assuming is that we'll only do half of what the average of the other people are doing. Though our rating will be much better than them, we just don't want to give a very a bombastic number and say that okay, this is what we'll achieve. So we are going very pessimistic in this and saying only 20,000. Let's say we'll only do 20,000 of sales. So that is the model. That is how the model is built on. Secondly, coming to the CL, the average revenue that desert brands which are rated 4.1 and above do is 25 to 30,000. What we are assuming is only 10,000 per day. So even that we've assumed taken a very pessimistic number. Now taking those assumptions into picture, and if we build a model for the next 12 months, this is how it will look. On the average, if you see, what we are assuming is that I'll just give a brief of what the model over here is. This shows how many stores of the brand we are opening in the respective month. So in the first month, we'll be opening 1, second month 6, third month 7, fourth month 10. So by fourth month, we'll have the full functionality ready. Even when you come to, so this is of the homely bowls. This table is of the homely bowls model. Below is CL Desert Bar. Over here again, if you see, we have assumed the same thing, that we'll ramp up within 4 months and we'll reach 10 outlets in 4th month. Now, on an average, if we are seeing that we are breaking even by the 4th month, and from 5th month onwards, we are seeing profits. Now, mind you, this is on a very conservative estimate that we are trying to build a model on. And if you see the average profit that we are trying to achieve from this is that 14.5 lakhs per month on a sale of 90 lakhs. So this is what is the thing that we are assuming. And out of this 14.5 lakhs, 7.5 lakhs, I mean 50% of it, 7.75 odd, will be shared with the investor. So the investor amount that we are asking is 25 lakhs is the minimum ticket size. And the total investment amount is 2 crores. In that, what we are saying is that for every 25 lakhs that you invest, your returns would be roughly around 90,937 rupees from 6th month onwards. So this number, we see that it might not go below, but it will definitely go above. But we are saying this is what you have to assume and go from the 6th month onwards. So this is what the model is about roughly. So for every 25 lakhs invested, your return that you can expect is around 91,000 rupees. I'll just give a brief of what all is going into the budget. For 2 crores, we are opening.
So is it per month?
Sorry, 90,000 per month. Yeah. So the budgets for each of the stores, I'll just go through. Homely bowls, for us, it is costing around 4,13,000. There is a brief about each item, what is going into it. For CL Desert Bar, 2,40,000 per outlet. For all these to do, we need to have a central production facility. We need some equipment over there. So that has been taken care of. Over here, we are saying that the total budget for both combined is around 26.2 lakhs plus 18.6 lakhs. That comes to around 45 lakhs. So the total capital expenditure is 1 crore 10 lakhs. And the rest, what we are planning to do is that we, having experience in this segment, we understand the advantage of having marketing. And the two, platform marketing. We want to heavily focus because most of these outlets will only be online. They'll not be offline. This is an online only model. So we have, if you see in the thing that we are showing the model, 30% we have taken it out as commission, which is the online commission. So that we have already included that 30% of the sale will be going into commissions. So what we have spent the rest of it is on marketing, which is very important, platform marketing. We want to do it in the best way possible. We want to have high quality videography and photography. This is what we do with all our brands. And so we also want to do it with this. We will do online promotions. We'll bring in the best influencers in the city and ask them to do reels about our brands. All that this marketing is involved. Marketing is included in this budget. And also additionally, we also have budget for discount promotions. So the total marketing budget is coming to around 67,90,000. Then we are having a running capital that we have put for each store is around 1 lakh per month. So that running capital comes to around 20 lakhs for 20 stores. So that's how the total budget comes to around 1 crore 98 lakhs 55,000. We have rounded it off to 2 crores. And the model is that we will be getting 50% of the profit from this project. I think this is what I wanted to explain. Now I would be happy to answer any questions that you want to ask me so that I can get more understanding of your interest.
Yeah, Narendra. So as you have told, it's a pessimistic calculation. So why we are waiting for 6 months if you are confident on the business model? So
No,
if
we are not waiting.
second month or third month, like generally you told 4 months will be install date, right? Like up to the mark 10 stores. So from
4
fifth
months.
month, so if the revenue is getting profit or whatever we are getting, so why don't you share with the investors? Why we are waiting for 6th month? That is one thing.
If you see, I'll just open the model again, sir. If you see over here, okay, this also has the total P&L every month. So in the first 4 months, we have a combined loss of around 8 lakhs 13,000. That is being absorbed by the company only. And from 5th month onwards, if you see, there is a positive cash flow coming in because we're continuously expanding. We will not be profitable on day one. So
That's what. So your calculation is based on the past history along with like forecasting, but it may be a deviation, right? So we can't come to the conclusion whether it will be accurate or not. So if in case in future if business done well and it went profit from the day one or like we are in the plus. So what is your stand on it actually? Are you going to share with the profits with the investors or not?
We will be sharing the profits because this is a project-based investment. So whatever is the profit, company has 50%, you have 50%. There is no two ways about it. And coming to the point of the sales, we are suppliers to Swiggy and Zomato for their food. On Swiggy and Zomato itself, though they have their own brand, it's called Everyday. You can check it in Zomato also. The rating of Everyday, in which we are the food supplier, is 4.4 with 10,000 plus ratings. We are using.
What is the store name under Everyday?
Everyday. It is called Everyday. Just the name Everyday. You can go to Zomato and open and say, just type Everyday. If you are in that location, it will show that store. So it's a day-long thing. Our products we have tested on their platforms. So we are already supplying to them. We thought, why not we do it for our brand also, because we have the good ability and we have our own outlets as well. So our estimation of the model is very conservative. I'm putting it because as of now, among 18 outlets, let's say 18 outlets, 6 outlets are new. So 12 outlets may say we are doing a sale of 1.1 crores with the existing setup that we have. Okay, and existing brands. Our assumption is that with 20 outlets, we'll at least hit 90 lakhs with these brands because these brands are high in demand. The products are high in demand. The bowls are high in demand and the desserts are high in demand. So we don't see a a demand, non-availability of demand. There is enough demand in the market. We want to capture it. So that is the reason we are assuming that whatever we do, our target will be above this, above the numbers that we have seen. And it is just that because of the model that we have built, because you are not putting a store with on a standalone basis. You are sharing the revenues, you're sharing the operational expenditure, you're sharing the employee cost, you are sharing the rental cost. So because of that and that alone, your cost of operating that brand becomes very less. That is the reason even at a sale of 20,000 or even 10,000, you are seeing profits, because it is a fractional operational model as well. We are not starting new outlets and asking you to invest in that. We are asking.
Okay, so you told like you're planning for 10 stores, right? With this 2 crore, 2 CR.
Yeah, 20 stores, 10 of each.
10 of each, yeah. So 20 overall. So you mean whatever the profits you are gaining, you are going to combine or consolidate, and you will be sharing with the investors. That you mean?
Exactly.
So how transparent your business model in respective of investors thing actually? So why? Because you are.
Yeah. So
can everyone be on mute once I'm done? Can.
I will tell you regarding the transparency. The model that we are going to we are planning is that we'll be giving you the login for point of sales. So each of the stores, because all of them are online, the only sales will be on Swiggy and Zomato. We will give you the access to all the stores. We'll tell you the app. It's called Rishta. You log in. In your login, when you open, you will see the sale of each and every outlet. How much of the sale is being done on that? Okay, and we are regarding all the operational costs every month. By the next month, if this month you will get by 7th, you will get the cost of goods, you'll get the cost of employees, you'll get the GSTs. We will give a P&L every month on 7th of the following month. You know the sales. There's no other way to for us to be directly in touch with you. So we are giving you the sales dashboard. You will come to know about the sales. We'll also give you the commission that is being cut from it, because that will be coming to the email. We'll give a common email to everybody. In that email, you can log in and check what is the commission cuttings. So this will be a very transparent account, and all of the money that you will be investing also will be in a separate account. So this is not going to be on the account of the primary account of the company. We are creating a special project account for this. We've already created. Some of the money has already come. So we already created an account. Into that account only, you will be asked to invest the money. And that account ledger, whenever you want, you can take the account ledger for it.
Whether the sales platform will be direct sales, or you are going to sell this online also?
It will be online. Most of the 20 outlets, all of them, because we are using the kitchen side of it, all of the 20 outlets are online. If there are any sales that happen, it will happen. So we see somebody is coming to the kitchen and saying, I like your product, I would want to directly buy from you. We will sell it across the desk also. But it is not like we are going to ask them to only buy across the desk, because primarily these will be kitchens. If somebody, we will entertain them and okay, we'll give you, but it will hardly be 0.1% or 1% of the sale.
What would be the platform of online sales? Direct Jelly Belly, or
no? Sorry.
The online platform will be.
It will be Rista, RIST.
Sorry.
.pay. The software's name is .pay. So that is the software that we use for the company as well. And for this project as well, we'll be using that software. There is an online app for it called Rista, Rista. You can download that app, and once you log into with your login, you will check. You will see whatever outlets are online. What is the daily sales? What is the discounts? In which platform you got that sale? How much was the sale? And the trend.
So is it a third party app or is it your
It's a third party app.
Okay, so you mean I didn't understood the business model. So you're telling like everything is online platform, right? So
Yeah.
the centralized kitchen operating at single place, and the front end stores will be operated across 20 locations.
Yeah, 10
So
locations.
if in case a customer has been walking into any of one of the store, if you want to place the order, so do you think like you are expecting customers to place online, or like they can purchase at the desk level?
They can purchase at desk level, sir. That's what I'm saying. So they can purchase at desk level, but out of the 10 locations that we are starting, all of them are, most of them, I mean, 6 of them are cloud kitchens. So they're only on cloud. They only have kitchen space. So if somebody comes, we will entertain and give them the sale over there. But the expectation is that less than 1% or 2% will be coming in that way.
Okay,
If somebody
so
comes, we will not deny them. But let's say, for example, we have a store in Madhapur. I'll give you an example. We have a cloud kitchen in Madhapur. It is facing in the main road only. It's in that main road near to Country Oven, Madhapur signal. So that kitchen is a cloud kitchen. We don't promote seating space and anything. It's only a kitchen. Now, sometimes what happens is that somebody will know that, okay, there is this 100 and cloud kitchen is over here. I want to go and directly order from them, and I'll order to the kitchen only, and I'll take it. So sometimes people will come directly, walk into the kitchen and say, I don't want to order from Swiggy and Zomato. I want to just order from you directly. Can you give me? Yeah, then we will punch the bill and we'll give them. So people coming like that will be very less.
okay, if in case in future, if the investors need the audit or something, so is any third party audit happening every quarter or something? Is there any proposal for that, for the sales point
Audit
of view or
audit is a choice, sir. If any investor is wanting to do an audit, I mean, you're welcome anytime. Like if you can check, you can see the books. That's always available. We have our central kitchen in Sheikhpet, Film Nagar. So you can drop by anytime. You can check the books anytime for the project related to the project. And we don't have any specific audit because every month we're anyways giving you the P&L and the accounts. So in case somebody needs an audit, it's a case-to-case interest. Somebody wants to have an audit, they can have an audit.
May I know what is your present turnover, please?
Our present turnover is 14.4 CR.
And how many
14.4.
outlets you have now?
We have 18 outlets now.
18.
18, yeah.
Okay.
So under which brand it is? 109 or like
100 and 100 and 100 is one of the brands. Gourmet Shawarma is the second brand. Courtyard is the third brand.
okay, all these three brands exist solely in Hyderabad or any across other cities?
Gourmet Shawarma and 100 are in Bangalore as well.
So presently you are in Hyderabad as well as Bangalore, is it?
Yeah.
So
So
if
is there any
you
sorry, continue.
if you open these 20, it will become 38 outlets, is it?
We'll be close to 40 outlets. Yeah.
Fine, thank you.
One thing, how much the profits are gaining from these 18 outlets right now?
Sir, as of now, our store level profits are depending on brand to brand. Our store level profit varies from some stores have 3.5, 4 lakhs profit. Some stores have 30,000, 40,000 profit. So overall, yeah, our bottom line would be around 13 to 14%.
Narendra, I have one question.
Yeah.
So you told the existing 18 outlets were there, right? So
Yeah.
these were being operated by the company or like a franchisee model?
Franchisee I have not included. We have 6 franchisees as well that I have not included.
ಯಾವ್ದು ಅಂಡ
Okay.
ನಿಜದಾಲೆ ಸಂಡ
18 is like a separate apart from 6 that you mean.
Yeah, 6 is separate from 18. So 6
Okay.
we have franchisees, 18 are our own outlets, company outlets.
Okay, so now we are going to establish 20. So how we are going to distinguish with the 18 apart from 20? Why? Because we are including the branding, marketing, labor, machinery, and everything, right? So I mean, it is carrying advantage. Whatever the investors putting on this 20, like it's carry the value to the 18 also, right? So how we are
No,
going to distinguish?
actually it is the other way around because the investor is getting the advantage of the existing place. Suppose if you want to open a new outlet, your rent would be 40,000 or 35,000 or 40,000 minimum. Now, because of we existing already on in that place, the new outlet of let's say CL or anything is only 1/4 of it. So your rent will be 15,000. So if you see the rentals that we have assumed, if you see the first month rental, you can see that the rentals are written as 15,000. Normally, you would not find rentals at 15,000 for starting a new place. Again, if you see the manpower cost, your manpower cost is only 48,000. That means I've only included 2 employees for this model in this outlet. So
okay, you mean
because
like
of that,
these 18 outlets will be sublet some space to 20, you mean? So the same location it will be presence or like
it's the same. It's in the same location. You can sublet might not be the right word, but you can say that shared space because it's the same brand, it's the same company. So there's no point. There's nothing of subletting, but you are saying that you're just sharing space.
So how we are going to bill the invoices? Suppose if you are telling
All
like
of these,
all
each
four.
of the outlets have their own unique IDs. The sales will be tracked on unique ID basis. All of them, the manpower, as I said, will be disclosed every month. That this is the 2 people that are working on this brand. So all that will be maintained separately. So that's why we are maintaining a separate project account for this project. So all the salaries, all the rents, all that will be going from that account only. And all the money coming from this sale also will be coming into that account only.
So you mean to say, even after the expansion, the old business will be separate from these 220 outlets, isn't it?
Physically, it will be possible, but regarding this back-end things, I think you are telling everything will be maintained under single account, right? Then
No.
whatever 18 accounts profit, I mean 18 stores profit apart from 20, so it will be commonly go into the single account, you mean?
No. That's what I'm saying, sir. See, this for this account, there is a project account for this project. The money you invest will be going into that project account. All the outlet sale will be going into that project account. All the expenses of the 20 outlets will be coming from that project account. Whatever will be left will be shared as profits between investor and the company.
So if suppose if a single place we have a 3 brands or governments and other one is 100N, whatever you're talking about, Homely and Sile. Okay, 4 stores. I mean, so 4 brands were present in a single store. So you mean all these 4 will have an individual bill payments?
Yeah, everything, because we do it like that also. We do it the same way even now. Even for 100N and Gourmet Shawarma, we have separate. Gourmet Shawarma employees are separate, 100N employees are separate. Though they operate from the same place, their sales are separate.
Okay, so now you mentioned here the marketing, right? So here you have mentioned the marketing, right? So the publicity kind of. So how we are going to market? I mean, what under which brands you are going to include this?
So the marketing will be used for the same, sir. There are 2 brands that we're launching. I mean, with in this project, one is Homely Bowls, one is called CL. CIEL Desserts. So these are the two brands that we'll be launching, and under these names only we'll be doing the marketing for the products.
So there is no conflict of interest with the company Jelly Belly, like whatever the existing 100 and government
No,
of
because
shawarmas, whatever it is.
100 deals with sandwiches and juices, sir. Gourmet shawarma deals with
No,
wraps and
I understood your thing, but as an investor, so whatever the investment amount we are putting, so will it be spent only these two brands or like a publicity for other brands? I'm asking why, because it's a
no.
conflict of interest, right?
Yeah,
So
yeah.
it's a win-win situation for Jelly Belly. So
Yeah, yeah.
it's the four brands, that's fine. But from investor point, if they are utilizing our money in other promotions for different brands, 100 and whatever it is, then it's
No.
a loss for like it's a deviation,
Yeah,
whatever
so
we agreed, right?
see,
That's
that's what I'm saying, sir. If you see this model, I think has not been shared, but we will the Invest team will share this Excel file also with you. If you see, each and every penny of the thing has been accounted for. You will know where the money is going. The money will be spent according to the model only. If you are seeing over here, if you see the marketing, we are saying that we will be doing 2,50,000 rupees of marketing across the 10 outlets for homely, let's say, for example. So that means we are spending 25,000 on platform marketing for homely into 10, 2.5 lakhs. That we'll do it for 6 months. So that is 15 lakhs. So each and every line item has been accounted for in this project model. So
okay. So is there any disciplinary in this?
Sorry?
Any rights? I mean, is there any disciplinary in this?
Is there any
specific disciplinary? So is there anything specified to investor, particular rights applied by the company? So if in
nothing, sir.
case, is there any concern from the investors, like a group of investors? So will their opinion goes as a priority, like a shareholder point pattern? So the same thing will apply
No,
here,
sir.
or
Yeah,
like
that one,
it's
that
solo
is
discrimination by the company?
Yeah. So the complete workaround is going to will be taken care by the company, because we understand the business better, and sometimes we have to take calls before the investor can understand that. There are some things where we understand that, okay, this is what we have to spend over here, or this is what we have to do over here. And this is a completely fully made model. So we want to go by the plan. That is why we had a complete model chalked out. We'll go by this plan.
Okay.
Whatever
so now
is
you to okay.
Whatever is it,
So
we'll only discuss before going into the plan, but we won't change the plan after going into it.
so everything will be fine at the management level.
Yeah.
So what I
So
understood,
there was mentioned like a royalty, right? So royalty fee. Generally, like if it is a franchising model, it will be like a fee will be charged. Now it is a proportionated 50-50 ratio with the investors along with the management company. So why there is a scope of it? May I know?
So see, franchising, that's what I said. The main reason to get into this, chalking out this model also was that there were many franchisees that were asking us to give the franchisee for the company. And for us, finding a new location, finding a new thing, finding a new place for the investor, interacting with the investor was becoming little tough for us to handle. While we are also growing, it becomes tough for us to satisfy the investors in that way also. So that's why we came up with this model where just like a franchisee investment, you have let's say you are investing 25 lakh of investment. Now you are investing in 20 outlets. Your 25 lakhs money is going partly into each and every outlet. So that way, all of that risk is being mitigated, and you are getting a returns after 6 to 7 months. The operations will be taken care by the company only. It is like a franchisee invested, company operated FICO model. So it's very similar to franchisee invested, company operated. Now,
so you mean there was a royalty fee?
There is no royalty fee. So
why? Because in the WhatsApp chart they have mentioned royalty follows.
No. There is no royalty as such. The royalty, see, the royalty, the efforts, the place that we are giving, everything is covered in the 50% profit that we are taking.
Okay, there is a misunderstand or there is a statement wrong in the chart. Then there is no royalty for 1 year, they mentioned clearly. So I'm not sure.
Actually, that is for the franchisee. That's not for the fractional investment. I think the one that you're referring to is the franchisee model. Our franchisee model has no investment, no franchisee fee, no royalty in the first year. I think that is a different thing you're talking about.
Okay, this is
completely different project you're talking about. From that only we came out and are doing this model.
Okay, now we are talking about the fractional one only, right?
Fractional investment.
Then there is no point of mentioning over here. But it was mentioned in the chart. That's what
I'm not aware because I'm not aware of what has been shared with you. But this is a fractional investment model we're discussing about. That what you're telling is about the franchisee investment.
Okay.
Hi, Narendra. So what is the cost you guys are planning for each bowl? See, it has to be competitive. So there are a lot of options in Swiggy and Zomato.
Exactly.
So obviously, people will see the cost variation,
Exactly.
while quality is also important. So
Yeah.
what is the average cost for non-veg and veg you guys are planning for this?
Sir, what we are planning to do is that we are going to put the price, the MRP price has 320 rupees per bowl, and we are going to give it at 195 rupees.
Okay.
So it is like we are playing into the psyche of the consumer. If he sees that the value of the bowl is 320 and we're giving it a discount, 130 rupees discount, it gives him more impetus to order from us. And what we are also targeting in our model also is that 195 to 200 rupees is what we want to charge the customer.
Okay.
So if
what is the what is the exit strategy for the investors if needed?
Exit strategy, sir, as I was telling, so I'll tell you about the lifetime, what we're assuming now. The lifetime of this project, we are assuming will be bare minimum of 5 years. 5 years, I think, why 5 years is because in the standard industry standard, 5 years is what we consider the lifetime of a restaurant. So we've taken 5 years is the lifetime of the project. If it goes more and over and above that, there is, we'll just continue it. We don't want to stop something that is giving us money. So that is one thing. Second thing, the exit strategy, there are two things. After 7th month or 8th month, when you want, if there is an interest that you want to exit, then we ask you to find an alternate investor for your investment and get that out. Or if you tell us, we give us some time, 45 and 50 days, somewhere around that. If somebody is interested, we'll replace you with that investor. That is one exit strategy. Second exit strategy is that since the company is growing, we are also continuously raising investments. We're going to VCs and all. If in future, when the company becomes at a particular scale and there is a large investor coming in, normally when the large investment comes in, they would want us to take all the franchisees and any other extra projects that we have done into the company. So then you will be given an exit at some X valuation. Let's say you are making good profits. So then they will definitely give a premium and they will ask you for an exit. So that is the second option. So these are the two exit options.
So that will be the forced exit from your side, right?
If the company is raising a big investment and the investor is insisting on that, definitely we will ask for it will always be at a premium, of course. I don't think it will be at a premium that you would not like, but that will happen, and that would be like a forced exit only. But that will always, post exit will always come into picture. That is already above your 25 lakhs investment.
Okay. At the moment, for your project, your complete total investment is around 2.5 crores, right? So why are you looking for multiple small investors instead of looking for a big investor?
Sir,
Because the capital is a small one.
there are two things because of two things for it. We are open to having big investors also. There are some big investors already. But the reason is if you are the time to close the 2 crore investment from one single investor will be higher, and specifically this project that we're doing is very time bound. It is very time specific because I'll tell you 2-3 things about the project, how we have, what information we have. So the reason we want to do it in the September and October months is because come November, Swiggy is coming back with its old company called Homely Bowls. It is Homely, not Homely Bowls, Homely and Bowl Company. So these both brands, it's going to relaunch in the month of November. They hold 60% of the market share. They used to hold 60% of the market share. They closed in the month of May. So that market share, 60%, is ready for grabs. That is the reason everybody is coming up with a new bowl company, and there is still a lot of market that needs to be captured. Now we see that there is a big opportunity here, and we want to capture that opportunity before Swiggy comes into the picture. That is why we are also, if you see, we are heavily spending on marketing also, because by the time Swiggy comes back with its own brands, we want to be established and exactly at least occupy 15 to 20% of the market. So we want to occupy. The reason that we are at a good place is because we already have 10 locations. We are already spread across the city. There's no need for us to go and expand in new places. We already have our presence across the city. So this gives us a unique advantage where we can scale up faster and capture the market faster. That is the reason we are doing this project in a very fast scale way. So was my explanation satisfactory?
Yes, yes. So one more question. So let's say, as you mentioned, there is a second option for exit, right? When a big VC comes in, so you will actually do the force exit for all the existing investors. So in that case, let's say if you actually run the business for 2 years from now onwards, so how much return we can actually expect as per the current calculation on the investment? Can you just give a quick glance?
How much return when, sir? At what point? Sorry, I missed that.
For 2 years. For 2 years. From now onwards for 2 years.
Sir, if you say, let's say we are calculating from 7th month onwards, you are taking for every 25 lakhs, let's say. That is out of 24 months, there is 17 months. 17 months into 3,000.
It's around 15 lakhs.
So you'll be recovering 60% of your investment by the end of the second year, sir. So 15 lakhs is what you will get, and your principal of 25 lakhs will still be remaining in the company, in the project.
Okay, got it. Thank you.
So I have a doubt. So the new investors will have the stake in the new products only, not in the existing products, isn't it?
No, sir. Yeah, only in the new products. It's a project-based thing.
Yeah. Thank you.
So regarding this marketing, so it was mentioned like around 25 lakhs, right? The cost of it. So
15,
if I'm not wrong,
total marketing budget is around 70 lakhs, sir.
Okay, so if I'm not like an exaggeration value, but if in case whatever we have put the corpus fund for specific category, if the money was been how it will be spending like across like what is the lifespan of it actually? So do you think like it was being spent in a single month or like a spread across different?
No, out of the 2 crore of investment, close to 1.4 will be spent in the first 2 months. So if you see over here, your capex is going to come immediately. So that is 1.1 crore. And your videography, your photography will be happening immediately. So that's around 13,50,000. And yeah, so 1.1 plus 13,50,000. So 1.25, 1.3 will be happening in the first 2 months itself.
So do we don't think like it's overspending on it actually? Why? Because like within a month you are telling like 1.2 lakhs or what is this? 1.3 something.
1.3 CR.
Okay, so this is only for photography and videography, and apart from you're talking about like influencers and some branding.
1.3 crore is for opening 20 outlets, sir. So we'll be anyways opening we'll be operating all the 10 outlets by the 4th month, right? So if you see by the 2nd month itself, if you see there is 7 outlets that are opening by the 2nd month, 7 in one each. So that is around close to 14 outlets there itself. So 14 outlets are opening in the first 2 months only. Apart from that 14 outlets, once the 2nd month comes in, we'll have to anyways plan for the next 2 outlets as well. So the capex or the capital infrastructure that we need to plan for it from the first 2 months itself. Whatever promotional activity we are doing month on month, that is something that we'll be doing spread across 6 months. So marketing, online promotions and discount promotions that we are doing, that will be spread across 6 months. But the majority of it will be happening in the first 2 months itself. And I don't think it is very high, sir. I think it is actually, I would say, very low if you're considering.
So the brand is a single brand, right? So we are opening multiple stores, but the brand comes under a single entity. So we are promoting in a single logo.
No, sir. No, I don't. I think I have to make it clear. Homely Bowls is a separate brand in itself. CL Desserts is a separate brand in itself. It has its own bowls company. We'll do its separate videography, separate photography for Homely Bowls. It will be listed as a separate entity in Swiggy, Zomato also. There, if you tomorrow, once we open Homely Bowls, if you go and type Homely Bowls, will be visible as a separate entity with 10 locations live. So Homely Bowls is a separate brand, CL is a separate brand.
Okay, so now you are telling like Swiggy is going to start their own brand, right?
Homely so, and yeah.
Purely you are planning like an online model. So how we are mitigating these market risk as a competitor is going to launch? So how we are going to mitigate? So the own brand will be top rated at their promotions and at the marketing level, and everything will be
true.
Thing. So how we are going to edge our position over it?
So what we are trying to capture is, sir, Swiggy, when it closed its kitchens in May, it had 60% of the market share. Roughly around 72 crores of revenue they were doing when they closed the kitchens. So now what we are only trying to capture is only 10 to 15% of the market. So how the two things that we are trying to mitigate is that we need to be faster to the market. We need to launch before November. Okay. And we need to do some very good marketing to establish ourselves as a player in the market. Once Swiggy comes into the play, obviously he will have more budgets. He's spending around 70 to 80 lakhs per day as marketing. We are spending the whole project, but he's spending that in a day. So we can't compete with him. I'm not trying to compete with him. I'm only trying to eat some chunk out of it, 10 to 15% of the market where I'm happy. And if my ratings are good, which I'm confident about, then I will slowly gain market share. And as a additional information, how I know all this information is because for Swiggy's bowl company also, they're coming to us only to be the food supplier for them. So we'll only be doing the food supply for them, most probably. It's still not finalized, but we are in the very late stage talks to finalize the deal. So now we also know what timeline they are operating on. Over here, we are not trying to get the full market. We are only trying to eat our own share of the pie, which is 10 to 15% of the market.
Okay, little clarification here. So even though Swiggy starts their own brand, so you are one of the contender to supply the material. I mean food, right?
Yeah.
Okay. So that also will be part of the current project, or it's a different one?
No, it is coming. It is at the company level. It's in the company. This project is not related to that. Yeah.
Okay, got it.
Yeah, two questions here from my side. First thing is the CL Desserts, whatever the second brand is there. What are the products which will be coming? Is it the ice creams, regular ice creams, competing with the Baskin Robbins or some other things, or it's more of the sweets kind of or a different
more on the
continent?
confectionery side, sir. You're true. You're right. It's more on the confectionery side. We'll be having tiramisu cakes. We'll be having chocolate sponge cakes. Then we'll be having jar desserts. We'll be having almond croissants. We'll be having operas. We'll be having eclairs. So if you want to understand the exact mix, we will be exactly like Harley's desserts. If I don't know whether you are aware of that brand called Harley. Will be very similar to what Harley's does.
Okay, and what is the revenue of Harley Desserts?
Harley does more than 1.3, 1.4 crore per month, sir.
And this is spread across only in Hyderabad?
It is only in Hyderabad, yeah.
Okay. So my second question will be on the Swiggy one. What was the reason they stopped a successful business in May? And why are they relooking to relaunch?
So that's an interesting story that happened with them. I think most of you might be aware that Swiggy is trying to go IPO. So they wanted to cut down on non-core business items from their operations. So Swiggy wanted to only focus on platform and streamline their operations. But I think in May, due to that reason, they closed on all good kitchens. They were doing very good. Actually, Ista Shawarma is also a very good brand. So they closed it. And then probably in the month of July, August, July last month only, I think they came to the realization that the food entity of Swiggy was giving them the money. It was actually a cash generating cow that they had to close down. So now they thought that, okay, we can't survive without this and we have to relaunch. But now what has happened is that in the month of May, when they stopped their kitchens, 4 of their kitchens we only purchased. Jelly Belly purchased those kitchens. So now they don't have kitchens. They've sold out everything. The equipments have been sold out. And because we purchased from Swiggy when they shut down their operations, Swiggy came to know that we are operating already, and they came to us saying that, okay, will you be doing the food for us?
Okay. So in May, Hyderabad alone, how many outlets were there for Swiggy? I mean, cloud kitchens.
They had around 16 pods, sir.
16.
Okay. Yeah.
Okay.
Yeah, Nanave garu.
Yeah.
Yeah, this you told that this is for 5 years only. Yeah, it's a lifetime. That lifetime is only for 5 years. What they just give me some clarification.
What I was trying to say is that we are assuming that the life is 5 years. We don't want to discontinue after 5 years, but generally after 5 years, we have to reinvest in the machinery. We have to reinvest in the place and everything. We're assuming that the lifetime of this project will be 5 years. If it goes more than 5 years, we won't stop it.
Okay.
I'm just giving you if to make a calculation for your own returns, you can calculate that. Let's say this project will stay for 5 years. That's a good calculation to do. That's what I was trying to say.
Okay. After 5 years, you want to close everything. Then what about our principals?
I would not want to close, sir.
Okay. If anyway, whatever the machinery and everything, if you want to again repurchase and want to reinvest everything in it, then
Sir, if you are continuing after 5 years, after 5 years, whenever the reinvestment time comes, then you obviously the existing investors are the first people that will reach out to saying that we need to repurpose this thing and we need to continue doing it. At that point of time, we will be not going for a new investment and new investors. We'll only do it with the existing people, because after 5 years, everybody might have made some money and there is a good thing going on. So I don't think that would be a big decision to take at that point of time.
Okay, after 5 years also, if you want again a call for a reinvestment, if I am not interested, then what about our principal amount?
If you are not interested about the principal amount,
if you want, I don't want to reinvest again. నేను మళ్ళీ అంటే మళ్ళీ మీతోని మీరు రీఇన్వెస్ట్మెంట్ పిలిచినా నేను రాలేదనుకోండి, నేను ఎగ్జిట్ అవుదాం అనుకుంటున్నాను 5 years తర్వాత.
ఓకే అది మీ చాయిస్ అండి. అంటే ఐ మీన్ విల్ నాట్ ఆస్క్ యూ ఫర్ రీఇన్వెస్ట్మెంట్ ఇఫ్ యు ఆర్ నాట్ ఇంట్రెస్టెడ్.
ఎగ్జిట్ అవుతామంటే మరి ప్రిన్సిపల్ అమౌంట్ పెట్టిన 25 lakhs.
అంటే సో సపోజ్ ఇఫ్ యు ఆర్ at that point of time, we'll be calculating the salvage value of the project అండి. Let's say after 5 years, it's not like the total project will be zero. As you can see, almost 1.1 crores for capital investment will be there anyways at any point of time. So whatever is the differential thing that is there, okay, today out of your 25 lakhs investment, in this pro rata basis, this is the actual what do you call value of the investment today. So we'll do that pro rata calculation, and whatever is the pro rata value, we will give that as your return. We'll return it back.
Okay. So within 5 years, there will be no fourth exit. Okay.
Yeah, even it is same for the like second exit and in between the like second. I mean, like within a 5 years, in between, if you exit also, same process will be applied.
Yeah.
Like
Even
you
if
said, like for the 2 years, you have been calculated at the K point, right? At a column.
Yeah.
So till that time, you have been received like 100,000, 10,000, 15 lakhs, 30,000, something as received.
So over here, one thing.
That point of time exit means how much principal will be received.
So that's what, sir. If you see, if after 3-4 years, it's how business functions is very simple. After if it's successful, so if anybody, let's say tomorrow you have invested 25 lakhs, okay, and your investment you are getting 90,000 per month for it. That if you calculate the interest rate for it, it is coming to around 4 or 5 rupees, I guess. 4 రూపాయలు వడ్డీ అంటాం కదా, 3 or 4, 4 రూపాయలు వడ్డీ వస్తుంది మీకు. సో ఎనీబడి ఇఫ్ యూ వాంట్ టు సెల్ ఇట్ టు, నాకు 25 lakhs పెడితే 4 rupees వడ్డీ వస్తుందంటే ఎనీబడి విల్ టేక్ ఇట్. So you can at that point of time say that okay, I'll not give it 25 lakhs, I will give it at 35 or 40 lakhs. Even then your return will be working out, because anything above 2.5 rupee is a good investment. So normally investment will go in that direction. So somebody
who is coming in, they will be providing like, like 2 rupees, 3 rupees on the top of the thing, and the principal will be given and that account will get closed. Now what I'm trying to say is Swiggy, such a big company itself, has been at one point of time they have stopped the bowls, right? So now they are planning to do it. Even for us also, we don't know, anything can happen. If it goes for 2 years and something was happened and we want to stop all the company.
So there are we'll calculate the two scenarios. So the worst case scenario, if we are not going to go ahead with the project did not work out as what we assume, then we will be calculating the salvage value of the project. That is the machinery, equipment, any brand value, anything that we marketing value, the brands that we have, whatever it is, the value we'll calculate. We'll put an X amount to it. That's a CA thing. I also can't exactly tell you how much it will be now, but there will be a salvage value. when the project is not going good. When the project is going good and you want to exit, it's called a premium value. So you will say that, okay,
that we don't have any much issues because 90,000 per month is a good amount. I just want to know, like, you're only selling, like, Swiggy has been stopped, even though have so much of
no, sir, if you see that again,
so something comes in a way, that, so what will be there?
See,
that's it.
Over here, sir, your worst case scenario is that you have capex investment of 1.1 crore. Okay, out of the 2 crore, so 50% of it is secure. There will be some depreciation, but 50% of it is in hard asset that can be sold at any time.
Okay.
So that is your salvage value, bare minimum.
Got it. So first it will start on the 7th month, 7th day.
Yeah.
Yeah, two more questions here. Sorry, maybe it's late to ask. I don't know. You're putting a cap on the revenue. The sales is 60 lakhs every year, even though you will spend more on marketing. Any logic behind that? Putting a cap of 60 lakhs sale only?
No, yeah, that's what, sir. We have made very
That's only indicative number you were saying.
Pessimistic. We made very pessimistic assumption. If
okay,
it goes
understood.
60,
Got it. Yeah, I'm okay with that.
If it goes 90 lakhs, we will share the 50% in that also. So we are not saying that we'll give you only 90,000.
Yeah.
If the good thing happens and we are doing 1.5.
Yeah, I got it. That your answer was crystal clear to me. The second question will be like, now assume that the Homely Balls brand is growing and you have to expand only Homely Balls for another 40. So the valuation will be taken for that brand and our investment value will increase?
No, sir. So brand is being owned by the company. So brand is with the Jelly Belly Foods. So what we'll be evaluating in the project is that for this project, we have this much revenue coming in, this much profit it is generating. So based on that PE multiples only, we'll calculate a exit amount
The
for
profit,
the project.
the 20 new are completely the Homely Balls, and you are creating a brand on the initial investment on the marketing, whatever you're doing. And at one stage of time, maybe 1 year out of that, the brand might respond well, and you are forced to add another 10 to meet the demand. So in that case, those 10, if you are investing, because we already developed a brand on our investment, so do we have any leverage or advantage from that new 10 investments to expansion?
No, sir. Actually, see, if you are in this project, there is a equal distribution, because this project, the returns, as I was telling, is only possible because your expenses are fractional, because the rest of the amount is not coming to you. Your expenses are fractional, and this is possible only one time. Only when we have 10 kitchens available, only then it will be possible. Now, when I start 10 more places, my rent will be full only. It will be 60,000. It will not be 15,000. So now that we are doing this project, we want to first make the utilization of the 10 places and get the returns faster for it. So that's the reason this project is coming into existence. Otherwise, this project would not exist. Because of the opportunity there is, the project is coming into existence. And the brand, whatever the brand is always a company, sir. Brand leverage will not be there. This is only on the project. Whatever we are doing in the 20 outlets, related to the 20 outlets, will be coming to the investors.
Okay. So naturally, you are saying from 7th month, we'll be having a 4% payout every month till maybe the 5 years or whatever the lifetime of that
whatever
project.
The thing is, yeah.
So this will be done on the 7th of every month.
Yeah. 7th month is what our model shows. 6th to 7th month, say we'll be starting the returns.
And it will be TDS of 10% detected at the source, or how is it?
I think the TDS will be only 2% or 3%. I need to check that, because this is directly coming from the company as dividend, right? So I don't know how much TDS dividends, what TDS dividends will attract.
Okay.
So whatever you get from the returns from this thing, sir, it will be considered as dividends.
Okay.
So do you have any plan to sell your equity?
Equity in this, sir, no. Equity is a separate investment, sir. It's into the company. So that is a separate investment. This is only for the project. There is no, there is a waiting and return time. Over here, there is a regular income time. So two different models. And there, I mean, if somebody asks why we are raising, why don't we directly raise this amount in the company and invest our own? The only reason is that we don't want to dilute our equity at this point of time. This is a non-equity dilution model that we have, where the company is not giving out equity. It is giving out its profits to the investors, and thereby it is increasing the revenue. If the revenue increases, the company's valuation will go up. So that's how it works for the company.
Yeah, one more, Narendra Garu. You are expecting 2 crores of investment from the investors. If you I think by the month of this next month only, you are going to close.
Yes.
This
Yeah,
month,
yeah.
maybe this month.
Yeah. September 1st week, by September 1st week, we are closing, sir.
Okay, by the month of September 1st week, September 10th, you are not getting the investors then?
Sir, if you are getting more than 70% of the investment, then company also is ready to go ahead. If you are not getting that 60-70% investment, then we'll not go ahead with the project and we'll just return the investment.
Okay.
Interested people, I request form fill చేయండి నేను చాట్ బాక్స్ లో పోస్ట్ చేస్తున్నాను. Like any further reports or further communication, please form fill చేయండి. నేను మీకు get in touch అవుతాను మార్నింగ్. Any more questions అండి?
No from my side.
Yeah.
Okay.
So we are concluding the session only. Thanks for joining the session. Thank you, Narendra Garu, for explaining the project.
Thank you.
Thank you so much. Bye and good night. Form link నేను చాట్ బాక్స్ లో పోస్ట్ చేస్తున్నానండి. సో ఇంట్రెస్టెడ్ పీపుల్ ప్లీజ్ ఫిల్ ద ఫామ్. మురళీ కృష్ణ గారు, ఫర్ మోర్ డీటెయిల్స్ ఫామ్ ఫిల్ చేయండి. మేము మీకు మార్నింగ్ కాల్ చేస్తాము ఫర్ మోర్ ఇన్ఫర్మేషన్.
Okay, no problem. Thank you. Have a nice day.